Welcome to Financial Revelations Podcast. I'm your host, David Safransky. It shouldn't be a surprise to you because I'm your host every week, but if it is a surprise, I'm David Safransky. Now, right before we get started, I want to tell you that if you have a question that's unique to you and you want it answered on the podcast, you could send that question to, it's right here, Joshua at EPSF.com. Joshua at EPSF.com. And any questions, comments, anything like that, if you'd like me to stop doing the podcast, you can send that to Joshua at EPSF.com. And I want to get started right away because with one question that I've had, and I'm not kidding, I've had it 100 times in the last week, and that is, what is going on with this stock called GameStop? GameStop is a publicly traded company that buys and sells video games, and they're generally on a CD. In fact, I think they're all on a CD, and some of their games are old and some of their games are new. And if you have a game that you've played and you don't want it anymore, you can take it to GameStop, and they'll generally give you about 25 cents for it, a game that you paid $60 for 3 months ago. And so people get really discouraged when they go into GameStop. And the problem for GameStop is that their marketplace has slowly been dwindling because all of these game consoles now that are put out by Microsoft and other people, they have hard drives that can store a lot of video on them. And so most of the best games are free and you download them. So you don't have to go into a GameStop to buy the game. And GameStop has physical locations. There's one about a half a mile from where I'm talking right now. And these physical locations, of course, you have rent and people and inventory and all these things. They're very expensive. And the game developers are all circumventing places like GameStop and Walmart and other places like that because they're not producing CDs anymore. And so the business model for GameStop has been very, very challenged. And what happens is, especially right now because of COVID, so you couldn't go out in a lot of places. You couldn't go to stores. A lot of stores were closed. So that's challenge on top of challenge. And so profits are down. A lot of their stores couldn't open. So some people on Wall Street use this strategy when they think a stock is going to go down in value called selling short. And I'm going to explain selling short to you in the most basic terms that I can. So there's a stock like GameStop, and people think it's going to go down. So what big investors do is they go and they borrow the stock from somebody, let's say at $20 a share. They borrow it and they sell it. So they sell the stock at $20 and they're hoping it goes down to $10, which they would buy it back at $10 and give the people that they borrowed the stock from their stock back. And the difference between that is $10. So they sold it at 20, they bought it back at 10 and gave it back. They have $10 a share profit. Now, there's some carrying costs. You get charged interest to borrow somebody's stock, so there's a little bit of carrying cost to that. But that's exactly what was going on with GameStop. These big investors had shorted the stock. And not only had they shorted the stock, but essentially they had shorted every available share, plus 15%. That was new to me. I did not know that you could short a stock 15% above what actually existed in the market. And so all these big investors are thinking, well, GameStop's business model isn't that good anymore and they can't open because of COVID. Certainly the stock is going to go down in value. And in most cases, they were probably right. The problem for them is that people revolted. And they don't really like short sellers. They're they have a bad name on Wall Street because they're betting against the company. Quintessentially against America, by the way, because America, we want people to win. In short selling, you actually want the company to lose. Now, you don't necessarily want them to go out of business. You just want the stock price to be lower when you buy it back and return it than when you sold it earlier. And so these small investors and some big investors, Chamath Palihapitiya and Elon Musk, all kind of teamed up against the short sellers and started buying the shares of the stock. They started buying shares of GameStop. And what happened was the price started to go up. And the price went up so high that the short sellers had to close out their positions or risk losing everything. And the only way they can do that is to buy the shares The problem for them was nobody was selling. Only people were buying. Now, it's true, whenever somebody buys a share, there's somebody on the other side selling, but there was so much interest in buying that the short sellers could not get enough stock to close out their position. And all this interest, all this buy-side interest, was really driving up the price of the stock. So what happens on Wall Street is there's a book. It's an electronic book now. On one side of the book, it says how many people are willing to sell. And on the other side of the book, it says how many people want to buy. And if there's this huge imbalance from the people who want to buy, there's way more people who want to buy than people that want to sell, the price starts rising. And that's exactly what happened with GameStop. And it's called a short squeeze. And in a short squeeze, the people who are short the stock are watching the price go up. And so they have to get out. They're getting squeezed. Their profits are getting squeezed. And so they're hurrying into the market to try and buy. There just weren't enough shares to satisfy the demand, because not only was everybody buying, at least that's where the indications were they wanted to buy, but they had also shorted more than the available shares, making it even worse for the short sellers. And what happened was GameStop went up about 600% in a very short period of time. I don't own GameStop in the firm right now, mainly because I don't like the business model. And I haven't owned it for a long time. There have been times over the years where I owned GameStop. Unfortunately, this is not one of those. But a lot of other stocks that were heavily shorted were also getting caught up in this. So Bed Bath & Beyond got caught up in it. American Airlines got caught up in it. And in general, when a company, so we call the available amount of shares to be bought or sold by the public the float. If the float is shorted 20%, that's high. That's very high. If it's shorted 50%, it's very uncommon. GameStop was shorted 115%. Extremely uncommon. I don't know that that's ever happened before, but it happened in this case. And that's what made this trade so interesting, because it was so heavily shorted, and a lot of people on Robinhood and other online brokerages got involved and were buying the stock, driving it up. And some big investors got behind it too. And there was some message boards where they were talking about doing this and other stocks. A very unique position. I have never seen in my career, which is now over 28 years, I've never seen individual investors take down a hedge fund before. Now, is there enough moxie behind the individual investors to really affect the market negatively? I don't think so. But it will have an effect on individual shares, individual companies like Citadel, who was shorting GameStop. They lost so much money they had to go out and get outside investors to shore up their capital. And I'm sure that there are some companies that are going to go out of business. And that's the risk of the trade. It could happen just as easily if you own the stock and it goes to zero as if you short the stock and it goes to 200. In this case, GameStop went north of 300. Wild moves. Wild moves. It's not really the kind of trading that we like to do. Now, we did own some shares that got caught up in a short squeeze, and we were able to take inordinate profits on them. And what happens is when you have a company that you bought at, I'll use my personal example here in the firm. I'm not going to name the company. We bought it at about $12 to $16. We've held on to it. It pays a huge dividend. And that's really the reason we bought it, was for the dividend. But then you wake up one morning and the stock is trading at near 50. These are profits that you have to take. Now, I didn't take all the profits immediately. I waited to see what was going to happen. So I have the position. And then when it went back above what I had just sold it for, I came out of the position because it really did what we wanted it to do. It made a lot of money in a very short period of time, and you have to take those profits sometime. Now, there are stocks that I just don't like to sell, and one of them would be Apple. We have tons of profit in Apple. It's one of our largest holding in the firm. Every time I sell it, I've been left thinking, I wish I hadn't done that. Now, in March of last year, we bought a ton of it because everything was low. That was one of them. And so those are companies that I really don't like selling, but I will from time to time. put some trailing stops on some companies that I really love because everything is so high priced. At some point in time, you have to clock some profits, and that's what we'll do. And so the way that we do it is we have a position, and we don't generally come in and go out on a daily basis, but what we will do is manage around that position. So I might take 10% of that position off, buy it back later at a lower price if we get that opportunity, or just reinvest in something else. So these short squeezes, though, are totally unique opportunities. And when they come along, you really have to strongly consider taking those positions off, especially if it's not a stock that you really love. And the stock that we had, I didn't really love it. I had it for the dividend. I don't even like the stores. They tend to be very cluttered. It was a great opportunity, so we had to take those shares off. And we'll reinvest that at a later time. So that's what the short squeeze was all about in GameStop and American Airlines and Bed Bath & Beyond. And today it's in silver, where silver, I think, is at a 9-year high in price right now. Not a lot of people own silver. They own this ETF. It trades under the symbol SLV, Sierra Lima Victor. And so if you own that ETF today, it's probably a good idea to start looking at trimming positions. I think probably these short squeezes will go on for some time and then settle down and be forgotten. One of the things that happened that people really didn't like is that firms like Robinhood stopped your ability to trade in those stocks. And one of the reasons why Robinhood was so popular is because Robinhood, you open up an account on Robinhood and you do anything you want. They don't ever ask you why you're doing that. It's you. You're the one investing. If you open up an account with us and you want me to do something really silly, I'm probably going to have you pump the brakes a little bit and slow your roll because I want to make sure you really want to do those things. And I have talked people out of crazy trades in the past where they'll call me and say, hey, I want all of my money in Twitter. And I just say, no, I'm not doing that. If you want to do that, you have to take your money to TD Ameritrade and do it because I'm not going to be behind that trade. I don't put all of anybody's money in any one thing. I certainly wouldn't do it for my money, with my money, and so I'm not going to do it with yours. Now, what I will do is if I think a stock is going to outperform the market, I will overweight in that stock, but I'll protect it too. And this is the thing that individual investors don't do. When they bet the farm, they don't protect the farm. Now, you could do that. It costs a little bit of money to protect the farm when you're heavily betting in one thing, placing a lot of money in one thing. You have to protect those things. You do that with options. What Citadel did wrong in the short sale when they got squeezed is they didn't protect the stock from going up. So what you would do is to protect your stock and get out, you would buy calls. It's an option. It's a very basic option. We do this all the time for people. We buy puts and calls and spreads and put spreads and call spreads. But when you do that, you're protecting yourself. Citadel did not protect themselves, and they got caught with their shorts down. And that's why they're in so much trouble. Now, they got shored up, and when firms like Robinhood stopped letting you buy more than one share of GameStop, I think that's going to significantly hurt Robinhood in the long run. They're a private company. Technically, they can do whatever they want, but people go there for the ability to do what they want. The other thing that Robinhood does, which is unique, is they let you buy full and fractional shares of an individual company. So, for instance, Amazon today is trading north of $3,000 a share. Well, if you had $100 to invest, you could invest $100 in Amazon, and you're going to own a fractional share of Amazon. That is kind of unique. It's exciting for people to be able to do that, but if they're going to limit your trading when they don't like what you're doing, then I wouldn't trade there. I would go to a more reputable firm, a bigger firm who's not going to let you do that. To the best of my knowledge, I was never restricted from buying any amount of GameStop that I wanted. They might not have been able to deliver the shares because they just might not have been in the market. There was such a buying frenzy for them. So that's what happened in the short squeeze this week. It's why when you manage money for a living, you love to see these things come along because most likely you're going to own something that's getting squeezed to the upside and you can take profits. But as for our firm, It's not a manner of practice to short companies. One of the things that's unique about the United States is that our markets tend to trend up over long periods of time. If you have a very volatile stock in the market, it could be a potential short target. Or if you're trading in a market that is just very choppy, it goes up and down all the time, South America, Russia, markets like that, those are heavily shorted markets. And if their stocks trade here via an ADR, an American Depository Receipt, you could short them here in our market. And that's where a lot of that action happens. Now, during COVID, a lot of firms got shorted because you couldn't open. You couldn't open your store, and of course your profits are going to be lower, so it would be the prices would go down. And a lot of people don't like the fact that is betting against a company during COVID, and I can sympathize with them. However, it's totally legal. There's nothing wrong with it. The one rule that I would change is there was a rule called the uptick rule. And what that rule was is in order to short a stock, it first had to go up in price, even just a 16th of a penny. It had to go up before you could short it. And they took that rule off. And what that allowed short sellers to do was create immense momentum to the downside, because as the price fell, they would short it more, creating more downward pressure, shorting it more. And I think that really creates a momentum that has nothing to do with business strategy or business plan or profits or lack thereof. It's a momentum trade. And I think the people who manage these exchanges, the FTC and the SEC, I think they would be wise to bring the uptick rule back, because it really did make people think long and hard before they took a large short position in a stock because it was going in the opposite direction. And so I like the idea of bringing that back, because when you get a lot of downward momentum at an increasing rate that has nothing to do with the profit or the loss of a company or their business strategy or anything, it's kind of a false premise. I don't like betting against companies. I like betting on companies. Now, mind you, as I say that, what we do isn't betting. We don't bet. We calculate. We have calculated portfolios. We could tell you the math on them. It's very easy to discern. And so when we're taking a risk, we're doing it in a very calculated fashion. And because of that, we have been able to outsize returns, and our portfolios have done very well. Doesn't mean we're not subject to losses and things like that when the markets fall. But on the way up, because we're calculating these things and we're really rooting for companies to succeed, I just like that strategy a lot better. I think it's probably hard for a lot of short sellers to sleep at night, and I'm okay with that. It's way harder today for them to sleep at night than it was 2 weeks ago. But I don't want to see anybody go out of business. I want to see people do well. I want to see people get profits. I want to see them expand business markets. I want to see our economy grow. The best news that I have heard so far this year, aside from that I was able to sell a stock that I didn't think was ever going to go to that price, at that price, is that hospitalizations are down for COVID. The vaccine is getting rolled out. The other good news is that in populations that have been vaccinated, there is a 50% decrease in infection rate in those populations. Now, that could mean that at the time of vaccination, they might have already been infected or shortly thereafter, but you are seeing huge drops in infection rates in vaccinated populations. That is working. The COVID recovery economy is on the way. Now, it's probably going to take the rest of this year, but we will see really good bits of news along the way. And we got to be ready for that, because I think this year, when we look at it in comparison to last year, 2020, it's going to be a good year. Businesses are going to be expanding. Restaurants will be opening up. The cities, these major metropolitan areas that have been essentially closed, will be reopening, and good things are going to be happening. So I want you to know, You can email us, Joshua at epsf.com. Joshua at epsf.com. Questions right here. And one of the things that we're going to be working on here at Financial Revelations over the next couple of weeks is a way to get some interviews lined up. We have interviews that we could do, just the technology for us. We're kind of technology novices at this, so we're working on this diligently, but we're going to have that. And my first interview is going to be a Super Bowl winning football player from New Orleans. And we recruited him right out of college, and we took him all the way through his career. He played for 12 years. He's still our client. Wonderful person, great family guy, the voice of the radio voice of the Saints. And so he's still around the team, and he's got a lot of insight into money. And I am going to put him on the spot and ask him about a few of the mistakes that he's made and how he one time wanted to punch my face. Financial Revelations Podcast. Thanks for listening. Thanks for watching. Tell your friends. Email Josh at Joshua at epsf.com. Your questions, comments, concerns. And we'll see you next week. Thank you, guys.